All right, folks, it's about 2 minutes past the hour here. I see folks are still joining slowly, so welcome everyone. Let's kick off today's session. I'm Eric Valiquette. I'm the CEO of the Blockchain Supply Chain Association. Always happy to have some returning faces or returning names here join the session. And for those who are new, quick shameless self-promotion here. The Blockchain Supply Chain Association is a industry association that helps promote blockchain in the supply chain world. And what is the supply chain world? It's absolutely everything around us, right? It's these phones that we all have, it's the clothes that we wear, it's the computers we stare at all day. All this is about supply chain, you know, from moving parts from around the world to assembly, to get it to consumers, to paying for all of these parts, which is where trade finance comes in, right? We have a great subject around trade finance today. So what we do at the association, we do three things. We do some advocacy work, so we talk with regulators. We actively work on standards globally. We also network our members together. We work actively on specific projects, and we do education sessions like this, webinars, newsletters, workshops. We build courses on blockchain for supply chain. For us, it's all about the community. It's helping the community understand what blockchain does for a living and how it can help us move forward in our supply chain worlds. So that being said, enough about me. I will hand over the microphone to my good friend Andrea, who's our chapter president in Europe. Andrea, the floor is yours, and I'll let you introduce our very special guest today and kick off the live stream in about 1 minute.
Perfect. Thank you so much, Eric. Today is a special day for me. It's the meeting, the first of two meetings. This is the introductory one. We're going to talk about trade finance distribution initiatives, and it's going to be the introduction to this great initiative. Second meeting is going to be held in September, middle of September. We're going to see folks from Tradeteq. So it was my intention to display what blockchain in general can do for trade finance. A pleasure to start from the biggest pain point in the industry, which is, say, the trade finance gap, and how the industry is moving to fill this up. So I thought it would be natural to invite one of the main person involved with this massive movement, which is André Castelman. And it's sort of continuation of the speech that he held on March 16th at the Happy Ledger Trade Finance SIG group. So it's my pleasure to introduce him. André, you can take the stage now and take the word. Stage is yours, and you can start talking about the initiative. Thanks for joining us, by the way, today. It's a great pleasure and an honor for us to have you here.
Thank you, Andrea. A pleasure for me to be on a session with you again. And thanks, Eric, also for your kind invitation to share the latest information on this initiative. I see many friends on the participants list, like Dominic Broom and many others here, Francesca as well, and Clayton. So great to see many known faces or names. I don't see the faces yet. And hopefully we'll have time indeed for questions. That's why maybe I'll go through a set of slides, not all of them, to get started. And then we take your questions. Yeah, I like to produce slides, but in the end, I also favor interactivity. So that's why I don't want to use most of the time just for presenting. So definitely the session here is about the Trade Finance Distribution Initiative. But before we get into that particular topic, I want to give a helicopter view. That's how I like to think and work and talk when I start, at least, not going too quickly into a very specific topic, but give it a bit of perspective and context. So if you don't mind, I'll start with 4 major market transformations, which I published on LinkedIn a few days ago because I updated this recently for a seminar, a company meeting with Bank ABC in Bahrain. And I was seeking feedback indeed from the community and looking for your feedback today here as well in terms this can be improved. And it can always be improved because we're living in an environment that is changing quite frequently. So the 4 market transformations that I want to highlight, and there is more to come in the slide as you would expect, is a role around the new client expectations. The clients expect much more from the service providers, whether you're a client versus a bank or you're a client in the bank-to-bank space. And of course, this is all usually driven by more digitization, faster processing and accessibility to services in an online fashion. But I'll give a few examples afterwards. The ESG trend is critical. We see it from the regulatory side, we see it from the asset management side, the banking side, the corporate side as well. It's impacting the whole corporate and banking ecosystems, and we have to take that into account. And of course, technology is also there to support this new priority, which I would put at the same level of importance as the sanctions and the whole compliance wave we have seen since the global financial crisis of 2008. So ESG, very important. Then another major market transformation is the new entrants in the market. And the new trends here in trade finance is mainly all about institutional investors getting into the market and supporting the trade space with additional liquidity and risk appetite, of course. And then the tokenization and digital assets from a tech side is also something we are seeing as impacting and driving innovation and new use cases in trade finance. And might be emerging, this is the start, but quite an exciting start. So those 4 trends, I suggest, are the ones that are basically a way to summarize what is happening from mainly a technology side, market trends, but of course technology is a bit everywhere in trade finance. And this is all enabling transparency and accessibility. And of course, I will now use proof points to explain why I'm using those words. And of course, this is where we could have a debate about what is missing and what needs to be proven indeed, because there are some perspective here about what might happen in the future. So a few proof points, for instance, in terms of new client expectations, it's all about getting much more transparency indeed on any processing. It happened in the logistics space with the DHL delivery. You can track the life cycle of the delivery since years and years, but in the cross-border payment space, it's only happening now with Swift GPI enabled since a few years, I should say, and offering visibility on cross-border payments. And in trade finance as well, most of the processing the banks are doing on checking documents, for instance, are being reported more proactively to banks because they are more and more becoming digital. And that's what the clients expect, to know more about what is happening. The clients know it takes hours or days to process some transactions, but they want to keep a finger on the pulse of the whole end-to-end process. And of course, most of this transparency is all about getting status information on transactions, and this status information is also used for with some machine learning for trade-based money laundering, and contextual intelligence is provided by machine learning on the basis of transaction data. So that's really about how clients are expecting much more transparency on the existing business, basically. Now, when we talk about ESG, this is fairly new regulation, new requirements, mainly coming from the asset management side, but also the corporate side. And this is all about offering more transparency. what has happened with a particular transaction with regards to ESG. What about the gender balance in that company, on the board of that company? What about the age of the kids on a particular plant where goods are produced? All of this has to be provided so that companies can, and banks, of course, which are also companies, firms can be sure that the transactions they get involved in are compliant from an ESG perspective, because there is a huge reputational risk if you're getting involved in transactions that you should stay away from. Then the third trend or market transformation is all about trade as an investable asset class, where we see indeed the banks in need of new liquidity to be provided by those who have the liquidity and potentially also the appetite to invest in the real economy through other instruments that the classic instruments, the mainstream instruments like corporate bonds. And trade finance is a great way to indeed get more transparency on transactions, because it's very rich with data fields on the transaction. Is very also clear about the types of products, and the ESG checks can be performed on those. And that's why institutional investors more and more are considering and engaging, for some, still too few, investing in trade finance through trade finance funds, extending liquidity to banks and or to corporates, mainly on the mid-cap and SME segment, which is no competition necessarily with banks, because it's all about providing the liquidity that banks are not able, for various reasons, risk appetite, regulatory capital, able to provide to the mid-cap and the SME space. So it's a huge topic, and technology again is making trade accessible, which is why I put accessibility at the top there, to institutional investors. Now, the fourth one is digital assets. It's even more emerging than institutional investors, I would say. That's why I put it at the right-hand side. And it's all about being able to bridge markets in different way, making investments accessible in a different way through the use of digital assets on the blockchain, such as making trade as a new investment option for retail investors by enabling fractional ownership at a cost level that is much more attractive for those small budget investors, because retail investors obviously are investing less funds than institutional investors in any asset class, and certainly in trade as well. And this is what we're going to bring through TFD Initiative. I'll come back on that. But of course, also blockchain is used for other capabilities, such as sharing status information, acting as a public notary of documents that are exchanged between institutions. And that's what we're doing on the DNI initiative on the model law for electronic transferable records, where we enable indeed banks to share through public blockchain the status of title documents.
And hey, Andre, sorry to interrupt you here. I have a few folks saying that they can't see your slides, although I can on my side.
Yeah, that's strange, because indeed.
Yeah, indeed. I can also see them properly. Sounds strange.
Maybe it's their own
might
window
be some
on
all
this side.
I appreciate that. I'll take care of it. Thank you.
Maybe they have to. Yeah, sometimes you have to activate a window or restart Zoom to get access to the right window. So over time, as we offer more transparency, we make this data more accessible through various types of technologies. We are able to develop new use cases, such as tracking the financing status of receivables and making sure we can fight the double financing issue, the double spending, where corporates or SMEs are actually financing receivables through various funders and getting actually double or more financing on a single asset, which is of course fraud. So definitely the goal is not only to digitize what is available today, but also more and more add value on top of those electronic flows. So I'm really keen to get your feedback on that structure, those proof points. I have tried to exclude the classic stuff like APIs are important, the cloud is important, because we know that since years, although that is still to be maximized in terms of value in the trade space, but I've really tried to bring a perspective on what is happening, and that is not yet necessarily understood in the market. So hopefully that's useful as a first slide. I will be quicker on the next ones. The next slide is also taking a top-down perspective on new client expectations, ESG, institutional investors, and the tokenization with digital assets. And actually, the key message here is to understand that some of those initiatives are, or most of those market transformations are supported by new technologies, a combination of existing technologies, but new technologies as well. I'm particularly involved in data management and workflow digitization platforms and distributed ledger technology as well. So I think those are examples of categories of technologies that are starting to make a difference, because they enable indeed the new use cases we have seen on the previous slide to become real. And then, of course, the next step is to get them adopted by the market. But in some cases, and in particular for electronic transferable records, those digital title documents tracked on the blockchain, and the use of tokens to bring liquidity from retail investors into asset classes like trade finance, we need evolving regulatory frameworks, because the law is not always adapted to the technology options that the private market has created. So we have definitely also through various organizations, ICC, BAFT, ITFA, World Economic Forum, WTO, UNCITRAL, talking to national regulators, national policymakers, in order to make sure the laws are changing, basically. And the big thing, a major milestone happening this year is the new Electronic Documents Act that will be, or bill that will be approved by the UK Parliament to offer a digital option on the Bill of Exchange Act of 1882. And of course, at that time, people would not consider electronic records. Only paper would be was relevant then, but we are now in the 21st century, so we need a law to adapt to the 21st century as well. So combining tech with policy is very important, otherwise the market cannot take advantage of those new technology options, and those trends at the top will not scale, basically. That's the whole logic. Now, how are we going about helping the banks to take advantage of those new options and those new policies? What I've started in 2018 through ITFA and a few of the tech companies I had in the ITFA FinTech committee, I structured the work around two initiatives in order to map those technology options that those fintechs were starting to offer to the key market ambitions. And two of the key market ambitions I focused on back then, 2018, was the rollout of the model law for electronic transferable records through the DNI initiative. That's why I set up that initiative, to make sure we have a community, like a working group of firms, could be tech firms, law firms, banks, corporates, that are really keen to make MLETR, to bring MLETR innovations, so electronic bills of exchange, electronic prom notes, electronic bills of lading, to the market. And we have done some great work through that initiative, in particular getting the top trade vendors to adopt the Inigio trace original technology for electronic originals. So that's the DNI initiative, mainly a corporate to bank discussion. And then on the TFD initiative, which is the topic of today, with Tradeteq bringing capital markets expertise to the trade asset class, we decided back then in 2018 to set up the trade finance distribution initiative in order to indeed gather those institutions, banks and non-bank originators, as well as liquidity investors and credit insurers interested in digitizing and automating trade distribution. Because if trade distribution is not automated, the market cannot grow, the distribution market, the secondary market cannot grow, and we lacking liquidity for corporates to make use of. That's why you see an arrow at the bottom in terms of trade finance being positioned as an investment class, feeding the corporates through the banks and extending liquidity through the banks, thanks to indeed the involvement of new entrants, mainly institutional investors, and offering on the right-hand side to those investors a new investment class, trade finance being a new investment class where they can indeed allocate liquidity and get a yield from that liquidity. So that's the framework of how I have organized the two initiatives. We could think about additional initiatives, but in my view, initiatives is only relevant if we can market the market transformation, is we can link the technology and the policy change to the market transformation. Is not just about promoting one vendor versus another, for sure. And at the top, on both tracks, we have regulatory discussions and tracking of policy changes, because on the DNI side, we need the MLETR to be adopted by national regulators. And on the TFD side, we have also discussions around the need tokens being used as a technical option for retail consumers to access the trade asset class. So moving on to the trade finance distribution initiative, a few slides on that. The goal is definitely, and has been since we set up the initiative in 2018, to demonstrate how trade finance can be accessible to institutional investors, because if they don't invest, if they haven't invested so far, it was because it was very hard not only to understand, but also to access. If it's too expensive to access, people just stop spending the time on the asset class and go and allocate their liquidity to other asset classes. So we needed to show how technology made this asset class as accessible as possible, but as transparent as well as possible in terms of risks being transferred from the banks originating the deals to the institutional investors allocating capital and expecting a yield and potentially hits from the risks inherent in those transactions. So we have established the largest business community of trade originators, the funding platforms, and other stakeholders, mainly institutional investors and some service providers, tech companies, to really increase this level of automation and transparency. It could be in unfunded distribution, funded distribution, various ways, but actually we want to cover all of the options for banks to distribute trade risks and assets. So it's definitely a community backed by a technology platform and supporting by two main technology providers. So how does this link to SME financing? Because we're active in the distribution space, but we say we are helping SMEs, but we actually don't address the SMEs directly. But that's the whole point about making sure that we can help the banks respond to the trade finance gap challenge by making their balance sheet to work harder. And I have another slide for that. But at this stage here, I want to highlight two major white papers developed back then, 2019, March and September, as you see, where we demonstrate, we basically position the business practice involved in the originate and distribute model, whereby the bank is actually not keeping all the assets and the risks on their own balance sheet. That means funding it themselves, but they shift through automated distribution. They shift the risks and the assets or the assets to distribution partners such as institutional investors in order to address balance sheet management challenges such as the risk-weighted assets, and they remain in their position as a servicer of the asset. Of course, the institutional investors are here not positioned as funding the SMEs directly, but funding the banks that are funding the SMEs. So and that's definitely the purpose, as I already highlighted on the previous slide, whereby the trade originators remain the front line to the corporates, the SMEs, and the investors are working as partners of those trade originators. But the trade originators could be banks, factoring companies or supply chain finance platforms, and servicing those assets. That's the most important, and handling the client relationships. So basically the whole goal in this distribution space and the TFD initiative is to cover all of the mechanisms that banks and their partners are using to distribute risks and assets. It's not always there is not a single way to distribute. There is syndication, there is credit insurance, and there is notes issuance when the investors are actually working on the basis of capital markets investments and are not recognizing basically the trade instruments, don't want to get involved with the trade specificities, and just want to allocate capital through notes issuance. And in this case, we're talking about repackaging. And the same approach will be applied with tokens as we extend the proposition to tokens issuance. I'll come back on that. So the whole purpose is definitely to digitize, but mainly to automate, because as a bank, an originator distributes high volumes of receivables or payables, there should be no manual intervention. Otherwise, the cost of this distributing individual assets goes through the roof, and the business case is screwed. So automation is key. And as we see mainly on the major bank side, the market evolution and the impact of Basel IV is a major driver for increasing distribution to institutional investors that can bring liquidity, not only to credit the insurers that are taking risks, but do not extend liquidity. That's the classic credit insurance proposition to the banks. And definitely what the banks gain by distributing, they are releasing capacity on their balance sheet, and therefore enabling their salespeople, talking to corporates and SMEs, to fund more, basically. So increasing SME funding is definitely the purpose, but it is enabled only by releasing capacity on the balance sheet, thanks to the assets that are being distributed to institutional investors. So what's in it for banks at the end of the day is definitely making their balance sheet work more, originating more, distributing more, getting more servicing fees, not getting and sharing revenue and risk fees with the partners in the distribution space. And definitely by making the balance sheet work harder, they increase origination. That's definitely the purpose, and that's how the trade finance gap can be addressed, closed, hopefully one day. So from what one thing is very important here is making sure that the distribution space can become the partner for banks to define their origination strategy, because as banks first secure liquidity from institutional investors by pre-agreeing the types of assets the institutional investors are after. Some are after ESG, some ESG criteria, others are after some regional assets. So you can agree your distribution capacity as an originator beforehand, and based on this distribution capacity, you define your sales target on the origination side, and that's a way basically to secure distribution capacity before you start originating. And definitely the goal of that approach, of this originate and distribute approach, is to indeed increase your risk appetite, because you know your risks are not remaining on your own balance sheet, they will be passed on to partners that have a higher risk appetite than yourself. And automation is key to pass on those risks as quickly as possible, or to share at least those risks as possible. But as you operate more volumes, you actually increase your fee income. Certainly the servicing fees are increasing because you're handling more assets. So the fixed fees or variable fees, but the servicing fees are definitely the ones to be to be focusing on, as you are decreasing your risk fees and liquidity fees because you're sharing those with institutional investors. So that's really the goal of positioning the banks as servicers, servicing fees. And we're getting closer and closer to the cash management model where banks are handling huge volumes and not taking major profits on those volumes, but on each transaction in the cash management space, and it's definitely a servicing fee model as well. And that is definitely aligned with the Basel IV approach to make sure the risks are limited within the bank's balance sheet. So the challenge is to make sure there are enough trade finance funds ready to work with banks, because if we don't develop that market, a lot of banks will be able to distribute through technology, but if there is no one to provide liquidity, the market, of course, will not develop. And at this stage, I'm happy to share a few names that are partners of the TFD initiative and members of the community and partners in terms of implementation and working with banks. This is Santander Asset Management, which launched the Real Economy Fund last year in May 2021 with an initial capital of 25 million. And of course, things are evolving there, so maybe they do more already at this stage. I'll leave it them to comment on this. NNIP Investment Partners, which has been absorbed by Goldman Sachs Asset Management, which is an ESG-centric trade finance investor, and Allianz Global Investors as well, as you see here, with a 500 million euro under management for trade finance. So that examples of big names, partners of banks to provide liquidity specifically for trade finance assets. And of course, the more through TFD Initiative and the technology providers, mainly Tradeteq acting as the distribution hub, the more automation we bring, the more standardization we bring, the lower the costs to distribute and the higher the yield for those investors on the trade assets that they allocate funding to. So on the TFD website, you have a series of testimonials on why trade finance has become indeed an attractive asset class for them. We have recorded podcasts with each of them that are all available on the TFD Initiative website. And at this stage, I suggest I take a few questions so we can take the temperature in the room, basically, if that's all right. And I see a lot of chats. Hopefully, I can find a few questions as well in the chats. Anyone wants to start? Oh, yes, we see a first question here. Clayton, thanks. When could we see a Tradeteq global trade asset pool available to lend tokens to the trade finance fund to provide liquidity to SMEs? Yeah. So two questions from Clayton, thank you. The first one is always the most challenging to get. So thanks, Clayton, for kicking off this process. So what the big difference with TFD Initiative compared to the standard practice is that we have started back then in 2018 with building a technology bridge, the Tradeteq hub, between the originators and the institutional investors through repackaging, basically. We're bridging banking and capital markets on specific, quite complex trade finance instruments to distribute high volumes, portfolios of receivables, payables, and so on. So, and that requires notes issuance, repackaging, an SPV, Luxembourg, quite major investments. Now, if we can replicate this same approach with tokens, then we decrease the cost of this whole process, and we can bring retail investors, if the regulators allow us to do so, and we can basically extend the bridge to not only the institutional side, bringing millions, dozens of hundreds of millions, as you have seen, Allianz Global Investors, 500 million, only to trade finance to start with, but we can with tokens and the right policies and regulatory approvals, we can bring the retail community into the trade finance asset class. And that was not actually part of the initial plan, which is why agility is key in this market, because as you see tech evolving, policy evolving, you have more opportunities to innovate and to increase the accessibility of your business, in this case, trade finance as an asset class, to additional investors. Now, the good news is that this is all achievable. That's the first good news. The second good news is that this is all that has been part of our plan in 2021. That's the second good news. And the third good news is that we are ready with this. So this is achievable. This is delivered, but we are at indeed a few weeks now from finalizing the service offering and bringing this to a first version of this concept to the market. So indeed, we are taking advantage of tokens to provide liquidity to trade originators, for them to provide liquidity to their clients, and we will bring that to the consumer space through a partnership between Tradeteq and the XDC network with a specific token. More information should be available in the next few weeks, and I would hope the next session that Andrea and Eric are organizing with Tradeteq themselves in September, that will be the right timing to provide much more information, because I think all the regulatory approvals and final steps will be completed by then, pretty sure. So watch out this space. This will be a big basically concept to bring to the market, because indeed no one expects trade finance to become accessible to retail investors through tokens. Major deliverable by a TFD initiative, thanks to the partnership between Tradeteq and XDC Network. So, and you have more information on Twitter from this, on the Tradeteq account. Now, the second question you asking, Clayton, is I'm wondering where the Enigio digital document solution stores that document. Would Storex ever be a storage solution for Enigio? So Enigio document solution. So the Enigio solution is definitely more of a corporate to bank digitization solution, whereby it extends into the distribution space. But the whole point is to replace bills of exchange, prom notes, bills of lading, and other title documents with electronic originals. Now, those files, in the same way as paper are secured by banks and corporates, take a bill of exchange, for instance, those files will also be secured by banks and corporates. The Enigio solution produces a file tracked on the blockchain, secured with encryption, private keys, and so on, tracked on the blockchain, but there is no business data going onto the blockchain, and the file is actually secured by the ones producing the files. Could be the corporate on the bill of exchange, could be the bank discounting a bill of exchange, and no change to that. There is no business data going onto the blockchain itself. For some of those use cases where Storex, which is a distributed file storage on the XDC network, would be if some of those players want to use Storex, of course, definitely that is completely possible, because the only thing you need is to be able to store a file, which a Dropbox can do. Well, any file management system can do, whether you go for Dropbox as a centralized storage or Storex as a decentralized storage. So definitely, yes, that could be achieved. Now we need to see how banks are reacting to distributed file storage. Because it's not obvious for banks to start using those new concepts to externalize their data. So moving on, I see some additional questions. So you're getting active, very good. Thank you so much for the brief information, says Shobi. I would like to ask private company in blockchain IT how we can leverage the same in India and globally. Yes, I mean, all of those innovations, certainly the Tradeteq hub, and whether combined with the XDC network or not for the tokenization, are definitely global innovations. So as banks want to distribute and digitize their distribution, automate their distribution processes, they need also internal IT systems to be ready to distribute in this way, to feed the Tradeteq platform with the right transaction data. And this is where internal IT providers, trade systems and other types of systems have to be aligned with the hub, that the distribution hub that Tradeteq operates. So definitely private companies in IT active in trade finance are definitely there to support the banks from their internal development point of view. Then someone anonymously asked, who should pay for the necessarily new ESG frameworks and policies that map more deeply carbon tonnage with the bank escrow valuation through a third party? All right, so that's a very easy, very ESG centric question. Who should pay for ESG? I think we'll all end up paying for ESG. I think the approach of the market has been more and more to track ESG compensation and ask for companies to, or consumers to pay for any ESG compensation, whether you're taking a flight or operated in a particular industry. So everyone at the end of the day will pay for those ESG frameworks and policies, in my humble opinion. So no other question at this stage. Andrea, do you want to open the floor?
Yeah, actually, there is a question, if I'm not wrong, here in the chat. How much do you think tokenization will save for the SME traders, and how will that be aligned to Rtgs? So this is a good start for the question and answer session, Andre.
Yeah, so thank you, Jose Mela, for your question here. How much do you think tokenization will save for the SME traders? Actually, the issue with SME financing is usually the risk appetite. The yield that funders can get on SME financing is usually very high, but the appetite to take that risk in the banking system is quite low. So that's why I think on the tokenization side, we're gonna see a series of offerings. TFD Initiative is working with XDC Network so that liquidity can be brought to the originators. But you could also imagine tokenization bringing liquidity directly to the corporates via specific platforms. I think this concept will expand. We are the first ones, or part of the first ones, to launch a token for a very specific asset classes. But I think you're going to see more and more of such tokens addressing more risky assets in order to deliver more yield to those investors. A bit like you have multiple funds that you can invest in depending on your own risk appetite. Those tokens will be providing also the various levels of risk rewards. And so I don't think we are going to have a single token offering for trade finance. It's going to be a set of offerings, like you have a set of funds in a particular business, and we all make our own research and personal choices whether to invest in lower risk or higher risk. It's really a personal choice, and there is a regulation called MiFID about this, and definitely I see this the tokenization, that concept being exploding in the next few years. And each liquidity provider could be consumers, you and I, could be family offices with more liquidity, could be institutional investors. Definitely over time, the tokens will not be limited to the consumers. And but in order to feed more the SMEs, to fund more SMEs, we need more risk investors, and that's what we are missing today, basically. So definitely here a start to fund more SMEs. How will that be aligned to Rtgs, real-time gross settlement? Yeah, I mean the whole payment space is moving to real time. So the time between the investment decision of a particular third-party investor in the distribution space and the time to bring the liquidity to the SMEs will be shortened thanks to real-time payments for sure, which could be done also on the blockchain over time. Any more question?
Andre, it's pretty interesting, the concept of risk. We're talking about ESG, and ESG, as you can imagine, is all about risk and expanding the concept. How do you see, maybe we talk about tokens, what do you see in the future as new asset classes related to ESG and to carbon offsetting? Might this be fitting the concept of new assets to be brought into the picture of trade and trade finance? Because we internally, both with DCSA and also the Appalachian Fabric family, we're so much into this with the RIG as well, trying to dig out on how this concept might contribute to shape up the future of digital trade and trade finance.
Yeah, the ESG will initially be a set of new criteria. You check the NNIP ESG information. You can Google it, you will find it. The ESG fund, they have, as an investment manager, developed their own ESG criteria, and trade finance is brilliant for this because there is a lot of transaction data that enabled within the trade finance instruments, I mean, that enables investors to filter the assets they really want to allocate liquidity to versus others. So it's a brilliant asset class for ESG investors, but it's going to be a way to filter. Is this sufficiently ESG compliant for me or not? That will be the go, no go kind of filter. Now, moving on, ESG will create new, it's a new economy. You need technology to track ESG status information. You need certifications. You need more data exchange. Data privacy issues will hurt. So you need technology to address this. So there is a whole ecosystem, I should say, of players focusing on the ESG. And I compare it really to what happened post global financial crisis of 2008, sorry, where you got a lot of players focusing on compliance, sanction screening, AML, fraud, all are specific segments where technology expertise, law firms have helped the banks. So it's going to be a massive investment indeed in the market, and meaning also bringing opportunities to those who really want to do this right. But then there is a whole ESG offsetting where you have to pay to, like in the car business, you have to pay if you're not yet fully electric, and then those who are aligned with ESG criteria get the money. So there's a whole economy there as well, to and a set of regulation driving those new practices. So that could be another asset class as well. I'm not sufficiently expert to have a more precise opinion, but I see there ESG exchanges, carbon offsetting exchanges in this whole space. So that's why I put it really at the top of my market transformation trends, because I see a lot of impacts from this ESG transformation.
There are a few more questions, Andre, and maybe as we come closer to the conclusion, there is another question coming from Shobi Khan, and it's asking, is it possible we reduce the time of wire transfer and automation for manual submission for wire transfer each time. For trade stuff, it's great approach and understandable. Then there are two more questions from Arun Pandir and once again Clayton.
Yeah, let's try to handle them all because it's great to have so many questions from the audience. Great audience today, thank you. So on the wire transfer, yes, definitely. We're starting to use blockchain on the DNI initiative is really to track electronic originals with public blockchain. Could be XDC Network, could be another one. And the asset is digitized by Enigio, this electronic original document company. Now, on the TFD side, we're using blockchain to bring liquidity from initially retail investors, but will be institutional later, bringing liquidity into a particular asset class, which is trade here. But on both sides, actually, the next step is to use the same blockchain. On TFD initiative is, let's say over time, yes, we use XDC Network for TFD initiative and XDC Network for DNI initiative. We could add the payment process, ISO 222 payment, as enabled by Impel, for instance, as an extension of the tracking process on the DNI initiative, and as an extension of the liquidity process on the TFD initiative. So executing a payment, shortening the wire payments, going through correspondent banking, taking days and getting lost in many cases through correspondent bank, Swift messaging, and so on. Swift messaging is not an issue, but it's the whole end step-by-step process of correspondent banks that is an issue. We could move that as a payment flow on the blockchain as well. And XDC Network is positioned through Impel with ISO 222, a layer 2, focusing on the whole payment proposition. So that's definitely for Shobi's answer. With Arun's question on which evolving regulatory requirements for different jurisdictions, how trade finance distribution can be standardized to meet guidelines. Yes, on the trade finance distribution side, we haven't, there are still a few regulatory issues, such as the transfer of receivables across jurisdictions that can be an obstacle. But usually at this stage is mainly the token, the acceptance of handling liquidity via tokens. That is something that more regulators need to open up to. We have worked with European regulators. I see UK regulators, very progressive. I see Abu Dhabi also very progressive. But in many countries, the tokens, either they don't know what it means, or they're trying to resist it, or they haven't started working on it. So we have to work more with regulators to accept token issuance next to notes issuance. So the next question from Clayton is for multinational enterprise clients, does XDC and Tradeteq have its own operating system application for clients to access service offered by the ecosystem? Basically, no. The Tradeteq proposition is definitely towards originators. So you need a servicer of the asset. It could be a platform, a supply chain finance platform, like accelerated payments that you see on the slide here, or it could be another platform like Supplier Plus or Income Land. They are all servicers of assets, even if sometimes they don't run their own balance sheet. So we don't go directly to the corporates here. But let's see what the options could be in the future to bring more liquidity to the corporates via different ways. Could be factoring companies in addition to the large banks and the local banks, of course. Definitely Quant network over ledger is relevant, as XDC Network is already working with Quant. You have more information on Twitter for that as well.
Yeah, the announcement, by the way, by the XDC and over ledger, the crossing pathway, and there's a big move indeed for going bigger and bigger, in my view. Talking about interoperability and cross-chain works, you see there is another remark from Jose Mella. He's asking, thank you, Andre, great overview. What protocols will be established and what route do you see will be taken as blockchain versus DLT as a choice for future-proofing financial SME interoperability. It's good distinction between blockchain, I like it, and DLT, as simple as that.
Yeah. Basically, I think we need to always look at the business use case first and see how blockchain can add value. So the goal is not necessarily to position blockchain for the purpose of it. Like on the DNI initiative, blockchain is used for tracking, as I said, but the real value is in really the securing the electronic original as per the model law for electronic transferable records. And that's the value Inigio brings. It is using blockchain, but it's not a blockchain only solution. And on the liquidity side with the tokens, blockchain is great to bring liquidity via tokens at a much lower cost. But the real value is in the whole end-to-end process which Tradeteq operates, and bridging into the tokenization to bring this liquidity in the same way as the traditional method is to issue notes to bring institutional liquidity into an SPV. So we should be careful not to aim to push blockchain or DLT as the purpose, because that is not the purpose. We have to think about the use case. And as I said, the next wave we're working on with XDC Network is to bring the payment element into this. And that's where Impel has worked with BCP Group to bring a payment, ISO 22 compatible payment protocol on top of the XDC network. And that we could combine with indeed the electronic documents on the DNI initiative and with the liquidity over time on the TFD initiative.
Wonderful, Andre. This is great content, and I'm so glad that you were with us today, by the way, given, let's say, sort of appetizer for what comes next. Actually, we'll be back on the 15th of September. Hopefully you can join Christophe and Niels, by the way, given the full picture on what's going on in trade finance and in what I call digital trade finance. So this is great. Time is running out. I guess we come to an end, and I leave it back onto the hands of Eric to close down the meeting. Thank you so much, Andre, for joining us today. It's as I said, it's an honor for Blockchain Supply Chain Association to have you with us, sharing such great content. I'm really delighted, and thank you again and again. See you on 15th of September again.
Yeah, I look forward to that session for sure. We'll have more news to share. Exactly.
And we can't wait to listen to them.
Yeah, but they will come. They will come before the 15th, but we can definitely go deeper into it on the 15th. And I'll bring some banks on stage at the ITFA conference in Porto on the 7th of September to talk about those their testimonials, basically. So more and more, you know, I want to get the banks to talk about it, because they are actually the actual users of those technologies. It's coming. Thank you very much, Andrea and Eric.
And thank you, gentlemen. Very good session. The audience was absolutely on fire today with their questions, so we appreciate that very much. We always like the interaction. That being said, we will be emailing everyone the recording link once it's up on YouTube, and the edited version, and Andre's slides as well. So with that, thank you very much, everyone. We hope you enjoy the rest of your day, and we look forward to speaking to everyone soon. Thank you very much.
Thank you again.
Thank you.
Enjoy the rest of the day,
everyone. Goodbye.
Bye.
Bye-bye.